I'd like to begin today with a story about a company that had a meteoric rise in the late 1990s. Maybe some of you are familiar with it. Pets.com, one of those companies that caught the dot-com boom, entered the market with a novel concept of simply selling pet supplies to customers online. It was a company that had a simple name, an easily described business model, had an icon in its sock puppet that was well recognized and loved, and in fact had achieved great success in a very short period of time, having one of the more recognizable brands on the marketplace, an envy of many companies. The sock puppet was famous for its Super Bowl commercials, was seen in the Macy's Thanksgiving Day Parade, a widely respected and widely visible brand. Yet, within a couple years, Pets.com was gone and out of business, one of the first and prominent victims of the dot-com bubble. What happened at Pets.com? Well, a number of things. One, there was massive entry by others who were basically replicating the same concept. It wasn't that hard to sell pet supplies online, and so others tried as well. The story of Pets.com is a great illustration of what we like to call the fundamental principle of business strategy. Colloquially, if everyone can do it, it's difficult to create and capture value from it. The fact that it was easy for others to offer pet supplies online, in essence, may have doomed Pets.com to failure. To say this more precisely and put it in more economic terms, we could say the fundamental principle in the following way. In a perfectly competitive market, no firm realizes economic profits, or what we often call economic rents. So let me just take a few minutes to define this term, economic profits. Economic profits are returns in excess of what an investor expects to earn from investments of similar risk. In essence, what we call in excess of the opportunity cost of capital. Think of the following scenario. You can invest $100 million to get a $1 million return, or you can invest $500,000 and also get a $1 million profit at the end of the day. Clearly, the latter investment is favorable to the first investment, though they both have a return of $1 million in profit. The fact that you can invest your capital in other ways is in essence the idea of an opportunity cost. So when we think of economic profits, we're interested in those profits above and beyond that opportunity. You see some data here on the slide highlighting 3 different firms. This is all data taken from 1998 and is represented in millions of US dollars. In the light blue, we see accounting profits, what is often reported in the popular press, what companies have to report as public entities. For IBM, they reported an accounting profit of $6.3 billion in 1998. However, when we factored in the opportunity cost of the capital necessary to generate those profits, their economic profits were around $2.5 billion. Compare that to Microsoft. Microsoft posted accounting profits less than IBM at $4.49 billion. However, their economic profit was $3.776 billion. Now, the reason for the difference here is in part because Microsoft is not a very capital-intensive business. It's a software business, and as Bill Gates has once famously quipped, it's like printing money once you develop an operating system that becomes the standard within the industry there. Finally, look at General Motors. In 1998, General Motors posted a profit of around $2.9 billion. However, if we think about the economic profit that General Motors generated, it actually was a significant loss. And the reason for this, once again, is that General Motors required heavy capital investment to generate that $2.9 billion in earnings that they posted that year. So once again, as strategists, we're very interested in the notion of economic profits above and beyond your standard accounting profits. Now, how do we measure these economic profits? Well, there's a number of ways in which we might do so. One that's popular amongst researchers is what's called Tobin's Cube. In its simplest form, it's what's sometimes referred to as the market-to-book ratio. The market value of the firm, what investors think the firm is valued at, versus the book value of the assets it actually owns and possesses. Tobin's Cube is a more refined measure of market-to-book where you're actually looking at the replacement value of assets. Take a company like Facebook today and look at its market valuation, a very high market valuation, yet the replacement value of its assets is relatively very, very low when you think about the number of employees and assets that they have on the books. What's nice about Tobin's Cube is a direct measure of these rents, these economic profits above and beyond the physical inputs that the firm possesses. However, it is often difficult to calculate and have real in-depth knowledge about the replacement value of assets. The gold standard for measuring economic profits are what we call discounted cash flows. Cash flows, in its simplest way, are those dollars that flow to the bottom line after profits and after future investments that the firm might make. We're interested in the stream of those cash flows that a firm might generate moving forward into the future. And what we do is we discount those future cash flows. The idea of discounting is based on the idea that money today is worth more than money in the future, so we value more the cash flows you generate today versus those that you generate in the future. In this way, by discounting, we in essence capture this notion of opportunity cost. What if I had that money today and could invest it in a different vehicle? When we calculate then these discounted cash flows, we calculate what we call the net present value, or NPV. And generally, a positive NPV indicates a creation of these economic profits or rents that we're interested in.